Hi everyone, so my name is Zach Vines, and what we're going to look at today is the three different cash activities when we're dealing with the statement of cash flows: operating, investing, and financing activities. So to start off with, the statement of cash flows, one thing that's really important to keep in mind with it is all that it's looking at is physical, cold, hard cash itself. So at this point in accounting, you've probably been exposed to accruals and deferrals where, especially with accruals, what we're dealing with is that we're kind of delaying the cash disbursement where we can go ahead and recognize revenue or recognize an expense even though we haven't paid the cash for it yet. In those situations, that does not impact the statement of cash flows until we actually square up the cash later. So do not touch the statement of cash flows or try and consider something to be operating, investing, or a financing activity under that statement unless it literally involves physical, cold, hard cash itself. So like I said, the three activities are operating, financing, and investing activities. So first, the operating activities, that's basically what you do in the ordinary course of your business. So things like buying and selling goods for cash, or buying and selling services for cash, paying your employees, paying your utilities, just the things that you do in your normal operations is what's going to be considered an operating activity. So really, the operating activity is more of a catch-all activity, whereas the financing and investing are a bit more particular and a bit more specific. So once we go through an example at the end of the video where we have multiple transactions and we categorize them as either an inflow or an outflow in each of the various activities, sometimes you may want to see whether or not it's financing or investing first, and if it doesn't cleanly fit into one of those categories, odds are it's just kind of a catch-all thing we do in the ordinary course of our business, and thus it would go as an operating activity. So a financing activity, sort of like the technical definition of it, is that it affects your long-term liabilities and equity. Pretty much what that means is that it's a way of financing your company, or at least in most cases it is to sort of start off thinking about this. Think about a financing activity as being us going and getting a loan, and we have a sudden inflow of cash, and the purpose of that was to finance our company or to bring in capital. Or if we sell stock, the reason we do that is that we want people to buy our stock, we get that cash, and then we get to go do stuff with it. So it's not the case that financing has to be an inflow of cash. There are financing outflows, but it's going to affect your long-term liabilities and equity regardless of whether or not it's an inflow or an outflow. You'll see a couple of examples we'll do based off of that down the line, but for the most part, to kind of initially wrap your head around it, think about it as just an extra activity we do to get cash for the company to use to finance the company, not something we do in the ordinary course of our business like selling a good and stuff like that. It's something we're doing so we can bring in more cash to use. Finally, for an investing activity, that's going to be most of the time a purchase or a sale of a long-term asset or an investment perhaps. So if I buy a building with cash, that's an investing activity because it's considered to be a long-term asset when the asset is going to benefit you for more than 1 year. So things like buildings and vehicles and equipment and something that's an asset that has, oftentimes you're going to depreciate it over a long period of time. Not all investing activities is something you depreciate, but if it is a long-term asset and you purchase it with cash, that's going to be considered an investing activity. Also, selling it is going to be considered an investing activity because it's still related. It's kind of the other side of the same coin. If we purchased it and it's investing, to sell it is also investing. But those are sort of broad definitions to give you. I think this is best going to be illustrated with a comprehensive example. So we're going to go through 10 transactions, list them out as an operating, financing, or investing activity, either an inflow or an outflow, and lump those all into a final total for your net inflow or outflow for each of the activities. So let's do that right now. Okay, so now we have this list of 10 transactions, and what we're going to do is go line by line and try and pair those with whether or not it's an operating, financing, or investing activity, whether or not it's an inflow or an outflow, and then come up with our net inflow or outflow for each of those activities. So one thing I want to point out ahead of time is that some of these are going to seem a little bit tricky based on the definitions we just covered, but I intentionally put in some of the trickier problems that you'll run into when you're first learning these different cash activities because they're very good examples to hold on to whenever you do get to your exams, whenever you do your homeworks, your quizzes, and you have to identify those weird situations that don't cleanly fall into the definition when you're first learning it, but we'll just take it slowly, go step by step, and then funnel it into the answer. So let's do that right now. Starting off, we sell 20,000 of goods on account. Well, what did we say in the very beginning of the video? Unless it involves cold, hard cash, it is not a cash activity. So although I recognize revenue right there, I sell my goods on account. I recognize a receivable, they recognize a payable, no cash was involved. So until I collect some of that receivable in cash, nothing happens for number one. So number one has no impact on any of these three activities. For number two, we sell common stock for $5,000. Well, the purpose of selling stock is so that you can get an immediate inflow of cash, take that, and then go run your operations with it. So it's not necessarily something we do in the ordinary, it's not the nature of our business itself. You may sell stock in the ordinary course of your business, but if you're not in the business of selling stock, which you're not, that's kind of a supplementary financing activity, then it's going to be a financing activity right here, because that's the point of it, is to finance your company. So we say plus $5,000 in the financing activity right there. For number three, we purchase a building for $575,000. So that's going to be considered an investing activity, because a building is definitely a long-term asset. Hopefully when you buy a building, you hope to have it for more than a year. So if you're going to purchase something that's a long-term asset, have a long-term benefit of more than 1 year, that is going to be an outflow because you spent that cash. The cash is going out the door, and that's going to go into your investing activities. For number four, we receive a loan of $325,000. So the purpose of getting that loan is that we needed a very large source of cash right then and there. And so we get the loan so that we can finance our company. So I put that plus $325,000 because I'm receiving this cash as a plus $325,000 under my financing activities. For number five, we pay our employees wages of $43,000. Well, you have to pay your employees in the ordinary course of your business. It also doesn't cleanly fit into a financing activity or an investing activity, because we're not buying or selling a long-term asset, so it's not investing, and we're not financing our company one way or another by paying our employees. That's just what we do when we're running our business. So it's going to be an outflow, a negative $43,000 under operating activities. So then we pay off the entire loan, that loan of $325,000 from number four, plus interest of $13,000. So let's talk about paying off the principal first, which is just the face amount of the loan that we borrowed, the $325,000, because it was a financing activity to get that cash in the first place. To pay that amount back to the people who gave it to us in the first place is the other side to that same coin, and thus that is also a financing activity. It's just going to be considered an outflow instead of an inflow. So it was a financing activity coming in. The only reason you're paying it back was because of that inflow of a financing activity, so it must be a financing activity going out as well. As far as the interest is concerned, this is one of the oddball ones that you may not realize initially, but we didn't borrow the interest, keep in mind. We borrowed $325,000, but whomever gave us that loan, let us borrow that money, isn't doing it for free. They're doing it so that they can get interest on it. So when we pay them back, we end up giving them the full amount we borrowed, plus a little bit extra that helps it make sense that they gave us the money in the first place. So because that's pretty much the nature of the business that they're in, is that that's the cost of borrowing, is the interest. Whenever I pay off interest, that's considered an operating activity. It's the principal portion that's a financing activity, because if it's financing in, it's financing out, whereas the interest was a total supplementary expense that we had to take on. So that part's going to be considered operating, so there's the negative $13,000 right there. So a little bit of a tricky one, but just keep that away whenever you see an example like that. Okay, so now when we do number 7, it says that we're paying off our accounts payable of $6,700. So what that means is that we bought something on account at a previous point in time. And when we did that, we didn't pay cash for it. We basically put it on our tab for the time being so we could square away the cash later. So once we actually pay that off, we know that we're going to reduce our cash balance to pay off our payable. So we're going to say that's an operating activity, because that was simply something we purchased in the ordinary course of our business. Accounts payable just could be, purchasing perhaps inventory on account. It just could have been anything, but that happens in the ordinary course of your business. So paying off the account payable is an outflow of $6,700 under an operating activity. And then for number 8, we're paying out a dividend of $1,000. So keep in mind, what a dividend is when people invest in our company through the form of stock. They purchase stock from us. What they're hoping for is that I'm going to take their investment and I'm going to improve the operations of the company so that the value of the stock goes up so they can maybe sell it at a gain, or we're doing well enough that I'm going to pay out dividends. And a dividend's basically a little thank you, saying, hey, thank you for investing in me. Here's showing that we're making good use out of your investment. Continue investing in us, and it's a good sign to the market to show, hey, they're doing well enough to where they can pay their stockholders dividends. So paying out a dividend, the only reason you do that is because people invested in you by buying stock. So that was a financing activity coming in when they bought the stock. And so the only reason you're paying them a dividend is because of that financing activity end. It's going to be a financing activity going out the door as well. So the paying dividends of $1,000 is actually a cash outflow under financing activities, because again, it's the other side of that same coin. The financing activity coming in is what led to us paying that dividend, so it must be a financing activity going out. So number 9, we sell a building for $600,000 at a gain of $100,000. So what that gain is saying right there is that we had this building and we've been depreciating it for some point in time, because remember, when we have a long-term asset like building or equipment or a vehicle, we depreciate that or kind of allocate the expense associated with that asset over a point in time. And we'll have something called book value, which is the cost that we purchased the asset for minus what we've depreciated so far, the accumulated depreciation. And so what's happening is that I sold the building for $600,000, so it must have only been on my books, or like the undepreciated portion, the book value of it, must have been $500,000. Because if it's a gain of $100,000, that means it was sitting on my books at $500, but I sold it for $600, so that's a gain right there. But really, as far as your statement of cash flows goes, that's irrelevant information, because the gain doesn't tell you anything extra about the amount of cash we got. We just sold the building for $600,000, so that's the amount of cash we got. Just focus on the cash. Don't let that other information distract you from the point that we're literally counting green dollar bills right here. So it's just going to be an inflow because we sold the building, we get the cash of $600,000 for an investing activity, because it's the sale of that long-term asset instead of the purchase of one, which you might think normally as an investing activity. But again, other side of that same coin, to buy it, it's investing. So to sell it, it's also investing. And then finally, for number 10, whenever we receive a dividend, this one's really tricky too. So remember when we paid out a dividend, we said the only reason we did that was because it was a financing activity in, people buying stock from us, so it's a financing activity out to pay them a dividend. Well, if we receive a dividend, that is considered more operational in nature, because we didn't receive a dividend because of a financing activity. We received a dividend because we purchased somebody else's stock. And because that's considered more operational in nature, receiving a dividend is an inflow for an operating activity, hence the $5,000 right there, the plus 5K. So at that point, you just sum everything up for each of the columns, you get your net cash inflow or outflow, and you're good to go. So thank you so much for watching, and I hope that helps.